Well, in states across the country, there are a growing number of potential pension fund time bombs, and the Illinois State Board of Investments is no exception. Some recent analysis done on behalf of the fund, which oversees roughly $10 billion, suggests that in 10 years' time, it could be left with nothing, assuming state funding dries up and the fund's rate of return continues to slump. For more on the state's pension crisis, I'm joined by Bill Atwood. He's executive director of the Illinois State Board of Investments. He joins us this morning from Chicago. Bill, thanks for your time. We know that Illinois lawmakers are going to meet this week, try to resolve this crisis. As part of that, there will be a vote on whether or not, in your case, you'll be getting new money to pay pension benefits through a new bond issue. What are your expectations? Are you optimistic that that's going to be coming your way?
Cautiously optimistic is the term I would use. I'm expecting a vote to be held on Wednesday, and I wouldn't expect the Senate to call the bill if they didn't think that it was going to pass. So assuming the Senate does pass that legislation on Wednesday, that will provide the State Board of Investment as well as the teachers' retirement system and the state universities' retirement system with sufficient funding for FY 2011. But one has to keep in mind that it's good for 2011. It really doesn't do anything to fund the systems going forward.
Right, to help out down the road. And your group handles about a fifth of the money for 3 retirement systems. You mentioned one of them, the state employees' retirement system, the judges' retirement system, and the General Assembly retirement system. The reason we showed those numbers, which some outside analysis on your behalf showed that your pension fund could be left with nothing over 10 years, is in that worst case scenario where you're no longer getting money from the state, but also the rate of return from the money that you're putting to work is not what you would have expected it to be. And in the case of some of those retirement systems that we just highlighted, you have tweaked your estimates recently, have you not?
We have the state employees retirement system, for instance, reduced the actuarial assumed rate of return from 8.5% to 7.75%. And the judges' retirement system adjusted their expected rate of return from 8% to 7%. I would also add that the judges, in changing their actuarial assumption, predicated that on a funding mechanism being put in place. If a funding mechanism isn't put in place, the judges, I would expect them to lower that assumption even further.
Let's talk about what happens if you do get that new funding from the state. You'd been paying out in the last year something like, what, $80 million a month? In benefits. What happens in the new fiscal year?
Well, once the initiative is approved, assuming the initiative is approved on Wednesday, I would anticipate us receiving about $960 million on or about the 1st of March. We would then go back into the market and purchase the securities that we've been selling over the last 6, 7, 8 months to pay benefits, deploy those assets. Then the state employees retirement system would continue to pay the benefits through the end of the fiscal year. And then going in the next fiscal year, the state would have to determine how it's going to pay pension benefits in FY12.
It's been reported, Bill, that the state has been approached by hedge funds for help. We mentioned there's this reluctance to tap the bond market because of what it means down the road. Have you heard about any examples where hedge funds have been targeted by the state to perhaps buy or provide some short-term assistance?
Well, I'm not sure I would characterize it quite that way. The state, the critical data point here is the state has about $1.5 billion of accounts payable to private sector vendors. Under state law, after 60 days, those vendors are entitled to 1% per month. In fees, they refer to them in fees. I think that's public sector accounting jargon. For all intents and purposes, it's an interest payment. And unfortunately, the state's not making those payments. In order to keep those vendors basically afloat, they're looking to the private markets to provide the funding to those vendors in exchange for that 1% payment. The consequence of the state's fiscal situation is a wash. The state owes that money as it stands down, is paying the 1% interest, but by going to external providers, to hedge funds or alternative debt providers, it would programmatically provide those service providers some sort of funding. And I think that's really what the state's trying to do here.
Okay. All right, Bill, thanks for your time. That's Bill Atwood joining us of the Illinois State Board of Investment.